Welcome students for today's video. So we have seen two theories, one is Markowitz model and sharp index model. Now we will learn capital asset pricing model, that is called a CAPM. So the capital asset pricing model is the equation that describes the relationship between the expected return of a given security and the systematic risk as measured by its beta coefficient. So in this we will uh, study the relationship in the model, that is CAPM. It compares the relationship between the expected return and the systematic risk, okay, to the given security through the beta coefficient. So besides the risk, the model consider the effect of risk-free interest rates and expected market return. So we know RF, that is risk-free return interest rates. Okay, for example, government bonds and all comes as a risk-free. So how to calculate it? So the assumptions for CAPM, sir. First, market are ideal, no transaction fees, taxes, inflation, or short selling restrictions. So this is not true, but assumption is like that. There is a transaction fee, there are taxes, and there is an inflation. So second, all investors are averse to risk. Okay. So markets are highly efficient. All investors have equal access to all available information. Again, the assumptions vary. By assuming these all, he has created the model, which is not 100%, we can say, work. So all investor can borrow and lend unlimited amounts under a risk-free rate. So beta coefficient is the only measure of risk. Again, we use standard deviation also, but here is using beta coefficient. All assets are absolutely liquid and infinitely divided. And the seventh is the amount of available assets is fixed during a given period of time. Market are in equilibrium. All investors are price takers, not price makers. And the last one is the return of all available asset is subject to normal distribution function. So these are the assumption of capital asset pricing model. Now, if you look into the formula, we use the expected return is equal to RF plus beta into expected return of market minus risk-free rate of return. So ER represent the expected return, RF is the risk-free rate, beta is the coefficient of security, and expected RM is an expected market return. So when it comes to the market risk premium, can be calculated as follow. That is just premium. So it is equal to expected return of market minus risk-free rate. Then the risk premium of a given security, we can calculate by beta into expected return of market minus the risk-free rate. So this is the formula to calculate the CAPM, and next is the market risk premium, and third one is the risk premium, just risk premium. Now coming to the next is the security market line. So what is security market line? It is the representation of capital asset pricing model. It displays the expected rate of return of individual security as a function of systematic and non-diversifiable risk. So the risk of an individual risky security reflects the volatility of the return from security rather than the return of the market portfolio. So the risk in these individual risky security reflect the systematic risk. Now the formula to calculate SML line, that is security market line, is RF beta RM minus R. That is already been seen in the formula, CAPM formula. Now if you put it in this as a graphical representation after calculating all the values, okay, so this represents the systematic risk and this is all about the expected return. The above part is all about the undervalued stocks and below it's all about the overvalued stocks. So the main is M. So where it is putting all the combination of risk-free return and the M. Okay, so M is the important point over here. Okay, so it's all about the relation between putting into the systematic risk and the overhead sub. So M is the point where expected market return and the market is equal, including the risk free. If you look into this, so we put all betas in the chart and also put the expected return also. So the SML represent the trade-off between systematic risk, that is nothing but beta, and the expected return of all assets. So whether individual securities, inefficient portfolios are efficient portfolio. The major relative risk compared to the market portfolio of all stocks. So why we use beta to measure systematic risk, and volatility of security, that is different, higher or lower than that of the market if beta is greater than 1 or beta is lesser than 1 and is equal to that of the market if beta is equal to 1. So beta is equal to 1 means that for every 1% change in the market's return, on average security I's return change is 1%, that we already stated in the calculation of the beta. So how beta actually plays an important role. So this explains the trade-off between the risk-free, that is nothing but systematic risk, that is called beta, and the expected return of all the assets. Coming to the capital market line, it is the tangent line drawn from the point of the risk-free asset to the feasible region for risky assets. So the tangency point M represent the market portfolio, so named since all rational investors minimum variance, okay, and uh, should hold their risky assets in the same proportion as their weights in the market portfolio. So in SML line, we are taking beta, but in capital market line, we are using the standard deviation. So if you see the line, so M is represents, okay, that we have already seen in the last slide, that M represent the market portfolio. So named since all rational investors. So we use the formula, following formula to calculate it, and that all the values will be depicted. Now if you look at this R free, and this is RM, and this is standard deviation M, okay, and here it is beta, that for actually, okay, for SML. So leverage portfolio of risky assets, the line higher, then all the wealth is in risky assets. Then it represents some wealth is in risky asset and all the wealth is in risk-free assets. So this is how it is given. So this is the combination of risk-free and also the risky assets. This is how we calculate the CML. So if you look at the difference between SML and CML, so measure of risk. So here you use the systematic risk in SML, that is beta. In CML, we use a standard deviation, that is the total risk. Now coming to the application, tool used to determine the appropriate expected returns for securities. And here tool used to determine the appropriate asset allocation. So there is an expected return. Here it is all about asset allocation. We call it as percentage allocated to the risk-free asset and to the market portfolio. So for the investors. So definition wise, graph of the capital asset pricing model. And here it is graph of the efficient front end. And slope market risk premium. So here it is market portfolio sharp. So these are the difference between SML and CML.